Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
There is still nagging negative news on the inflation front. We know that the price measure has been, as used by the Fed, rising to a fresh multi-year high. That's the change in personal consumption expenditures price index. And this has been not only in the US, but we're seeing this across Europe. There has been the pressure of fuel as well as food. We've had many slides relating to that over recent weeks. But the fact that these pressures are now mounting seems to have made interest rate cuts receded as a reality. And the very fact that mortgage rates in the US are now reaching new highs, over 6%, is a suggestion that we're not going to see interest rate cuts there. And in fact, it will instead be interest rate rises. Staying on the inflation point, we know that the real pressure point has been wages. This has been an area that is obviously much more important for the lower end consumer. And we also know that when it comes to wage growth and the effect of the cost of labor, that has been a significant factor in influencing the ability of companies to maintain their margins. So this is an interesting chart for the Financial Times. We can see that CPI has, for the most part, flattened now. It was higher in the aftermath of 2022, hasn't risen significantly, but it has been more or less flat. We can look at nominal wages and real wages. Real wages have ticked downwards in the US, in the UK, Eurozone, more or less flat, been quite volatile in Germany, but ultimately have been coming down. So while nominal wages have been flat more or less across the board, although they did tick upwards in the UK, surprisingly, they seem to have now started to recede again. This is a critically important point, as this will relate directly to consumer sentiment. We know that in the US, consumer sentiment has been persistently low recently, and the UK, although it isn't measured as reliably, we also know there that there has been a general problem within the retail segment because consumers have been feeling the pinch, not only of higher prices, but also of higher rates as expressed in their more variable mortgages. So the European consumer, its inertia really is a reflection of its low sentiment there. So now we know why the consumer is perhaps so depressed. We see here that wages have been falling short. Another interesting discussion point that was put out into the media this week was a comment by Mohamed El-Erian. He was suggesting that the policy put, such as the safety net, the desire of institutions to swoop in to avert a crisis, is no longer a sure thing. He suggested now that the capacity of policymakers to respond to shocks is down across the board. And there wasn't a particular amount of detail in this article, but I think it is an important suggestion here that whereas markets have definitely grown used to interventions by central banks, whether it's through dropping rates, swooping in as a buyer of last resort, as we saw in the UK, or generally acting with a lot of telegraphing in order to stave off market crisis, that is definitely something that investors have now been weaned on. This suggestion is that flexibility is not there. The flexibility may not be there because events may have overtaken, in the sense that we do know that, particularly in the US, the transmission effect around monetary policy and the effect on the consumer has been much less pronounced in recent years, even though the Fed was trying to cool consumer activity through raising rates. It was less successful in doing so, primarily because many consumers already had locked in low mortgage rates and were not as exposed to higher interest rates. I think they also know that works in reverse too, that when they drop rates, there isn't always that immediate injection of stimulus into the economy. There's also now the rising inflation point, and we also know that rising rates, we discussed this in our discussion in Sydney with the HESTA economist, that the mere effect of higher oil prices, higher gas prices can have the same impact as a 25 basis point rise in rates.